inclusion is important because the goal of any government is to have inclusive growth, right? In order to have inclusive growth, you need inclusive finance, very important ingredient in the growth process. So the question I pose here is everybody knows that financial inclusion is good for development, right? There is a significant amount of evidence. But the question that I'm going to answer today is whether it is good for the institutions who provide these services. There are two papers which you'll find those papers on my website here if you are interested in getting to know the details. So what is this? What is financial inclusion? To begin with, we know we would like every adult member of the society should have access to basic financial services. What do we mean by basic? Basically, they would have at least access to a bank and having a bank account. Okay, that's the minimum. Around 70% of adults around the world have access to basic financial services, meaning they have a bank account, right? So basically these areas here, deep blue, these are the countries where most people, you would say over 90% of people have access to a bank. But look at these gray areas, okay? And these are the countries where people don't have, like around, I would say around 50% of those adults lack access to a bank. They don't have, they're excluded from the formal banking system, right? So clearly you can say that it is not a problem for the developed world. So when we talk about financial inclusion, we are keeping in mind countries in Africa, countries in parts of Asia, right? And Latin America as well. In developing countries, around 50% people have access, remaining 50 don't, okay? So you can see the number, 1.7, not just in terms of percentages, but in terms of a total number, 1.7 billion people. This is based on 2017 survey data by the World Bank. 1.7 billion people lack access to a bank. They are excluded. Banks are not allowing these people. They don't like these customers to be part of the banking system, right? Probably because it could be risky to serve small customers, like poor customers, right? And they don't want to have any business with them because they could be risky. This access to mobile phones and internet, that has increased significantly. You can see these numbers here, and that is enabling digital financial services. Okay, so there is this concept of digital financial inclusion, which is also being emphasized by policymakers in many countries, including China and India. Why it is happening? Because most people have access to mobile phone. Around, the number is like over 93%. In high-income countries, but in developing countries, somewhat similar. We all know that banks are always looking for new markets, new opportunities, and that's the way they could expand their business. Okay, you can't just always work with the same number of customers that you have had before. There is always this goal towards bringing in new customers, new people into your business. You can see here, India, there are other countries here, that deep blue, meaning like 500 adults per 1,000. Okay, so you can see like 50% for every 1,000 adults have access to this mobile, or they have mobile money accounts, right? So which means they don't go through, they could do this. Obviously, they could still have a bank account. You can also have mobile money accounts. There could be duplication there. But the point I'm making is that this sector or this market is growing. Obviously, there is going to be some gain. There could be fee income. These mobile operators could be earning that, right? Because banks are not taking these people in, so they would be losing that revenue, right? Now, so this is where clearly it's a benefit for these mobile operators. Now think about savings. When this money you save money through your mobile money account with these operators. These operators are not keeping money with themselves. What they will be doing? They will be putting that money in their bank account, wherever they have an account, right? Mobile operators, clearly, they have bank account. So the money will ultimately make its way to the banking system, right? If people are saving, if these mobile money account holders, if they save money with these network providers, mobile network providers, then that money will make its way to the banking system. So there is clearly benefit in that sense. They are not excluded completely. Banking system is not excluded, but clearly this is a loss of revenue for banks because they don't take these customers. When you get this money, these are being available at a lower cost. You know deposit rate, you know lending rate. If banks could make use of this money for productive investment, you know there is an interest rate spread. So clearly it is going to be beneficial. Directly it will give rise to an increase in return on assets for these banks, right? So therefore, the point I am making here is that if you allow these customers, if you embrace financial inclusion, what is the initial impact on banks? Immediately you will see increase in deposits, because the money that was staying outside the banking system would be now part of the banking system, therefore. And this could be because these funds are available at a lower cost, they are more stable, they're not going to leave the banks. It has been well documented in the literature. There you will find many papers which are written on this issue, that greater access to finance, okay, increases savings, it lowers income inequality, lowers poverty, and because it increases employment, it improves overall well-being. First, we will be doing through the supply side, what banks provide. Then we'll be looking at what people demand from the demand side, using a different data set. And then I'll look at, towards the end of this talk, I'll look at a specific policy intervention, and to countries which have embraced that pro-access policy and countries who didn't do anything about that. There are two dimensions here, outreach and usage, okay? So when we talk about outreach of banking services, we refer to it could happen both demographically and geographically. Our goal is here to show that financial inclusion is positively associated with bank performance, and the second hypothesis that we look at is that different countries have different types of banking restrictions on banking activities. There are restrictions on capital requirement. There is high capital stringency. They need to set aside, this capital buffer, capital conservation buffer, capital, counter-cyclical capital buffer. All these requirements are there because it's in bad times. It is going to be beneficial for banks, right? If you have additional capital. So in the presence of those restrictions, still, whether banks would still be interested in doing financial inclusion or not, right? So that's the story, that's the idea.